So let me quickly start off with uh, a hammer. A hammer always comes after a downtrend, and the anatomy of a hammer is something like this. You have to note very clearly that it has a small body. It has no higher shadow. It has a long lower shadow. Now, long is a relative word. So, the long is well defined that the long should be at least 2 to 3 times the size of the body. It means that if this is the lower shadow, then this lower shadow's size should be 2 to 3 times of the size of the body. The most important thing is it should always come after a downtrend. It should always come after a downtrend. The color of the body is immaterial. Irrelevant means this, I've purposely drawn it with blue ink. This can be red, this can be green, it does not matter. Does not make any difference in the prospective outcome. Make one point sure that this guy has to come exactly after a downtrend at the lowest point. And when we have a pattern like this pattern is called a hammer. It tries to hammer the prices on the upside. It's a reversal pattern. Now, if you read the books, this is where it ends and it says that you can expect the market to go up from here. But if you actually are trying to trade, I will suggest this is what you should do. What you should do is you should mark a little above the highest point of the hammer. You should mark a level little lower than the lowest point of the hammer. And you should only look to buy when the prices go above the hammer, the high of the hammer. When prices go and break this level on the upside, then only you will buy. And if you do so, you will use this as your stop loss. On the contrary, on the other hand, if prices comes down and breaks the low before it goes to the high, then the hammer is negated. The hammer was supposed to reverse the trend, but the trend is so strong that the hammer could not reverse it, so it's negated. As long as this level is not broken, the hammer is alive, the hammer is kicking. The hammer will only be triggered when this level is breached. So do not fall for any hammer whatsoever. You should be very clear that the hammer has to come after a downtrend, and once you've spotted it, you should wait for the high to be breached. Always. It's a fairly reliable pattern. You can expect 6 out of 10 they'll work, but then I do see a lot of hammers getting failed also. We will reach a stage where we will be far more comfortable to filter them out. Now at this stage, if you find a hammer and you've traded this and you've triggered a trade with a stop loss, candlesticks generally don't give you targets on the upside or downside. But I use a rule which experience has taught me. And that rule is always the length of the pattern. That is, whenever I see a hammer and if I have managed to trade the hammer, if I've taken a trade based on the hammer, then what I do is I check what was the trigger point and where is my stop loss. And I call this the height. I call this the height of the pattern. And if the pattern has to go right, trust me, it's going to exactly give you bare minimum the same height. Whatever was the difference is the one you will get on the top. This is bare minimum. It can give you 2 times or furthermore. But I have noticed one thing, that candlesticks are very good for short term reversals. If you want a 3 to 5 day kind of a move, candlesticks can give you very good information and can lead to a reversal. So every time or any time I trade a candlestick and I've got this level, this is where I take my stop losses to my cost and I protect my loss. 1:1 is something that candles are very prone to give you. They are short term, very good short term reversals. If the hammer, on the day the hammer had taken a shape, if on that day volumes was exceptionally high, it adds power to the hammer. If volumes are high, pattern is stronger. The pattern becomes really strong. This is applicable for all the patterns that we will do now. For any pattern, wherever volumes are high, it means it's got a punch. It means it's got a kick. It means that there's high chance of it to work well. Now, if the same looking candlestick shapes up and it looks like this, same small body, same no upper shadow, same long lower shadow, same 2 to 3 times of the height of the body, is everything is the same, but the only difference is that this takes shape after an uptrend, then this entire pattern becomes a hanging man. The hanging man doesn't seem like a very positive affirmation kind of a word to me, and it is a bearish reversal patterns, means that if we find something like this, we will mark a little below the lowest point and a little above the highest point, and we will only wait once the prices breaks this low. This is my trigger point. Only when this low is breached, there is a possibility of a reversal on the downside. And if there is a reversal, then I can expect that this much distance can be followed down over here. The hanging man. If volumes are high, obviously the hanging man is stronger. Now, if I ask you a question at this stage, again, the hanging man color is irrelevant, whether it is green, positive, or negative red, it does not matter. It can be any color. It can be a red hanging man or a green hanging man. The probability is still remains the same. Now, over here at this juncture, if I ask you everyone a question, that between a hammer and a hanging man, which one gives you more confidence? Which one will you think has a high possibility of going right and you're more comfortable trading it? Which one will it be? The hammer or is it the hanging man? So most of the answers are hammer. In fact, all the answers are hammer, except Samir, who says it's a hanging man. Now I'll tell you the obvious thing and the not so obvious unconventional thing. You see, the hammer is a very obvious pattern. Let me just quickly scribble over here. This is a hammer. Hammer has a long lower shadow. Obviously, hanging man also has the same pattern. So both the patterns have a long lower shadow. The lower shadow means that there was a recovery. So the bears was in charge, the bulls recovered and gained back the ground and went up. So essentially, this candlestick pattern has a very positive connotation. This candlestick pattern has a sense of recovery of prices. So it's got a bullish connotation. And because hammer leads to a bullish reversal, that's why everyone's answer was hammer. But then you might ask me that if this is a very bullish connotation kind of a pattern, how come a bullish pattern shaping up after a bullish market can lead to a reversal on the downside. How can a hanging man ever work? Hanging man will never work, because I see over here this is a positive trending market. This is a positive pattern. Then how can it lead to any kind of reversal? This kind of question should come to your mind. How does a hanging man work is like this. There is already an uptrend, so obviously the momentum is high and the prices are going up. As prices are going up, volumes are picking up. There will be traders who would have missed the bus at a lower level, who wouldn't have been able to participate at lower levels, and we use a term called buying on a dip, right? Now, this hanging man took a shape because there was some kind of selling at the top, which was mainly due to profit taking, and the prices came down to a certain level where the latecomers or the guys who couldn't participate in the rally, they wanted to buy, and they are the ones who are looking to buy on a dip, leads to this recovery, and it goes up. Now here is the game. If the selling at the top is stronger than that of the late buying, if the selling at the top is far more stronger compared to the buying from the latecomers, then prices may come down. And if they come down, and if they break this low where they entered, this is where the latecomers will get trapped, and this is where they will put all their stop losses and they will sell, they will exit, and as they exit we get a reversal. This is the psyche of a hanging man.